Hey guys, welcome back to Finance for Firefighters. Today's topic is going to be about emergency funds. So we're going to talk about what an emergency fund is, steps to actually build one, and then ways to maintain it and where to house it. So a lot of our discussions have been based on planning ahead, right? And a big thing you hear constantly in the fire service is better to have something and not need it than need something and not have it. And an emergency fund is a great example of this. So an emergency fund is something that's set up to basically give you a safety net to catch you in case certain things pop up that you're not prepared for financially. Emergency funds are there for unexpected things that happen, for emergencies. So financial stuff that can happen either related to on duty or off duty, and ways for you to cover that. So that's what your emergency fund's primary focus is. It's there completely set aside, separate from your budget and the rest of all of your other finances between investments and things like that, so that if something happens, you are prepared for it and you have the financial resources to do it. And you're not going to be getting into debt financially through credit cards or having to sell things or put yourself in a bad spot financially because you're not prepared to weather a storm. So some ways that for a firefighter that you would need the emergency fund potentially would be unexpected medical bills. Let's say some significant thing happens to your home and you have to repair it. Your washer and dryer goes out. Say you're early on in your career and you don't have a whole lot to fall back on financially. Having the emergency fund will give you that safety blanket in case some of those things happen. A lot of us would say, hey, I could just work overtime, but let's say that you're injured and you get injured off duty and maybe you're out of sick leave or you're out of vacation leave and you're not able to do some sort of light duty to be able to go in. The emergency fund to be able to set up to get you past some of those obstacles and be able to pay your bills if that happens. Setting up an emergency fund is also a great way to get started, especially if you're young or if you really haven't buckled down financially. If you're able to set up an emergency fund, it starts setting the tone for discipline and some organization for you. And if you're able to build that up to a certain amount, say it's $10,000 or $20,000, you're able to actually see that goal that you've been able to achieve. And it really sets a good tone for you moving forward if you're looking at investments or if you're trying to build up something for a down payment on a house or some other large purchase. An emergency fund amount is all based on personal preference. So there's ranges from 3 months or 6 months or up to 12 months of living expenses that you need to be able to cover. So if you go back to episode 6 and episode 7, we talk about budget and budget strategies, but set up your budget and remove all of the excess stuff. So really the emergency fund should be covering all of your needs categories. It shouldn't include any of your wants. So figure out how much of that is for you for a 1 month period, and then determine what you want to work towards for your emergency fund. Maybe you have a goal of having a month first, and then your goal is to build it up to 3 months or 6 months. Things that may want you to have a bigger emergency fund versus a smaller one may be something like maybe you're the sole breadwinner and you have no other source of income. Or if you have a lot of financial obligations that you have to meet, maybe you want some of that stuff set up. Or if you're newly hired and there's some sort of looming recession or something like that, and you're not sure if you maybe get laid off and you're not set up for the SAFER grant. Any of those examples would be good reasons to build up a bigger buffer, but a lot of it really is personal choice. Good rule of thumb is around 3 to 6 months is a good amount of money to keep for your essential expenses for an emergency fund. Other factors that may be good to consider are obviously the working spouse or not, monthly bills or not, but also the size of your family and all your other financial obligations that you have. If you have that, or maybe you want to be more conservative and have a bigger safety blanket for you, then build that amount of money up past that 3 to 6 months amount for an emergency fund. As far as locations of emergency funds, you don't have to do anything fancy. If you have one bank, that's where you do everything at minimum, it would be good to have a completely separate savings account with just the emergency funds in there. For my wife and I personally, we use one bank account or one bank for the majority of our bills, and then a separate bank, which is set up for really like our mortgage and then our emergency fund and some investment stuff like that. So you can do it a variety of different ways, but having a completely separated account for the emergency fund earmarked for that will be a great way to stay away from it, not use get into the temptation of actually spending it. It's also good to consider things like online banks that tend to have higher savings yields amounts, in the 3 to 4% ranges versus your traditional Bank of America, Wells Fargo, things like that, or a credit union. Those are decent. But the online-only banks, because they're set up online, you're less tempted to use them, and they tend to have better rates because they don't have brick and mortar buildings and as many employees that they're having to pay. So they're able to pass a lot more of those savings on to you. It's important to emphasize liquidity. So what's liquidity? Liquidity is basically your ability to have access to that money right away. A house is not liquid, right? It's hard for you to get the money out of your house. You have to either do some sort of second mortgage or a HELOC, or you have to actually physically sell the house. None of those things are quick. Liquid means that the most highly liquid thing you'd have would be cash in a safe or something like that. That would be the most liquid form of it. An emergency fund should be liquid, but it shouldn't be in a spot to where you have temptation to access it easily. So a bank account or a savings account that you can have access to quickly is a benefit, right? But having it potentially at another bank or at least a separate account is a better strategy to be able to resist the urge to actually spend that money. Another consideration is some folks maybe have the temptation to want to be investing that emergency fund. The downside about investing it is it becomes much less liquid. You'd actually have to sell it, and then there'd be tax implications and things like that if you set it up in that way. Another consideration is that you could use a strategy like a T-bill ladder, which I'll talk about in a different episode, or in CDs. And you could basically split up the amount of your emergency fund into, if you have 6 months of it, for example, you do 1 month is going to mature at a certain time, month number 2 at a certain time, month number 3 at a certain time. So you split it up into like sixths, like 1 month of each part of that. And then every one of those things is going to come up for maturity and you'd be able to have access to it. The downside about that is now you're sort of blending your emergency fund with your investment piece of it, which you should really try to keep them separate. But it is good to consider that depending on the safety blanket you want, if you're investing so much money or you're saving so much money for your emergency fund, it may be too much. If you have $50,000 or $100,000 in your emergency fund, well, that's a decent amount of money that you could be investing or you could be building wealth somewhere else with. So depending on your situation, like we talked about earlier, figure out exactly what you want to do and get to that minimum, or at least between you and your spouse, what your comfort level is for what you want in that account. So if we zoom into episode 4, I talk about goal setting strategies, and this is a great way to build up your emergency fund. Everyone's financial situation is different, but the method I hit on there is the SMART method, the SMART. It stands for specific, measurable, achievable, relevant, and then time-based. If you are building up your emergency fund based on a goal that you've set for that, we'll dive into an example and I'll show you a couple of different strategies for being able to go from having nothing in an emergency fund to actually having something decent, or at least steps to get to, hey, I've got a month's worth, or I've got 2 months worth, or 3 months worth, depending on what your goal is for that, and steps to actually get from having nothing in there to actually having something built up in your emergency fund.
The SMART method: specific, measurable, achievable, relevant, and time-based. So something specific means it's detailed. So the example we have here is I want to save for an emergency fund. If we make it measurable, we quantify it. Say, I want to save $10,000 for an emergency fund. Achievable means there's a realistic element to it that you can actually achieve it, and the how you're going to achieve it. So breaking this down further, I want to save $10,000 for an emergency fund by saving $500 a month. Relevant, it's necessary, something that's relevant to you. I want to save $10,000 for an emergency fund by saving $500 a month so that I can pay bills if I'm unable to work. And then time-based, adding a time portion to it creates a sense of urgency. So I want to save $10,000 for an emergency fund by saving $500 a month for the next 20 months so that I can pay the bills if I'm unable to work.
Some common mistakes folks make with emergency funds or a lack of emergency funds is if an emergency pops up, they throw it on the credit card. And the downside about this, as we've discussed in other episodes, is that if you're putting money on your credit card for some big, let's say you had a roof leak or you had to get some significantly costly thing repaired at your home that was tens of thousands of dollars, if you throw that on the credit card, now you're much, much further behind the 8 ball. You've got interest that you now have to pay for that. So if it was a $10,000 fix on your house and you're tacking on 20% interest on top of that, unless you're able to get all that money back really quickly and pay it off, you're much, much more likely to actually have that repair with the interest part of it cost several $1,000s more than what the actual repair was. Versus if you had liquid emergency funds ready in a separate bank account and say, hey, I'm not happy about this happening, but I can cover the cost of it and I'm not having even more damage, right? Roof leaks, that's going to damage stuff inside your house. It's going to damage furniture. It's going to damage other things like that that'll add to it, right? So an emergency like that you're not necessarily ready to take care of, if you have the emergency fund, you're able to pay for that, right? When that happens, obviously you're going to be in a spot to where you'd want to work extra days or overtime or have other sources of income or cut back on other costs so that you can replenish the emergency fund after that. But if you have it accessible and liquid, now you can pay for those things and not have to worry about the added cost to it. So stay away from the credit cards for those kinds of emergency costs. Reevaluate your emergency fund amount every year. So this should be based on your net worth. It should be based on your current financial situation. If your spouse started working, stopped working, if your bills increased, decreased, any of those kinds of things, you'll redetermine exactly how much you want to have in that emergency fund. Or if you have any other large upcoming expenses that you're not really ready to, you can sort of anticipate them. Hey, my washer and dryer are 4 or 5 years old. Maybe, they're going to be starting to go out pretty soon. That may not be an emergency fund thing. That may be something you can plan for ahead of time to where you don't have to use the emergency fund to pay for it. So an example that I have with a buddy of mine that served as why an emergency fund was important was early on in his career, he and his wife, young kids, they were both working. He was brand new and he hadn't built up a whole lot of money, in his deferred comp or any of those other kinds of things. They're trying to save for a house, but he was able to actually following some advice early, build up an emergency fund. It just so happened during probation, I think he was maybe 6 months on, transmission went out in their minivan. And now they only had one vehicle that he had to use to get to work, and the wife had to be able to go to her job and then take the kids to school and all that stuff. And they were in a really, really bad spot. The cost ended up being about $2,500. And at the time, between school loans that he had for his wife, for himself, and all the rest of that stuff, fortunately, they had the emergency fund to draw from to be able to pay for the repair right away. They just had to deal with maybe not having that for about a week, when the transmission was getting fixed. But they weren't in a spot to where they had to consider selling a car that they were going to get less for, getting into debt, buying something new, things like that. So there really are real life examples of how it serves to protect you, especially early on in your career when you don't really have a whole lot of other things to draw from. So in summary, the emergency fund is a very, very important thing. It's one of the first things you should be saving for. It serves as a good tone setting thing for you. So if you haven't really set up or saved up large amounts of money in the past, having something like that provides a safety blanket, and it also puts you in a good spot to be able to have goals, set them, achieve them, and then make maybe that down payment of $100,000 for a house more achievable. When you say, hey, I was able to save up 10 or 15,000 for an emergency fund, the house is going to take me a little longer to get there. But if you set it up in a way like we've talked about strategically to where you're not thinking about it, it's automatically done, you'll arrive at those large purchases down the road. So it'll set a good tone for you in that respect. If you have no emergency fund, start small. If you feel like you're really strapped for cash, do $100 a check or $100 a month, whatever it is. Start working towards it now. Automate it. Start building up that emergency fund. Go through your budget, figure out where you need to get to and where you're currently at, and work towards it. Ball's in your court for that, and it'll make a big difference for you. Makes you and your spouse feel that much more secure, and you are protecting your family that much better if or when things happen that you need to prepare for. Our job, we respond to emergencies all the time. That's our job, right? And we're prepared for that stuff. We're not surprised when we're called out for that. So don't let yourself be caught off guard if emergency pops up for you guys financially. All right, guys, thanks for joining me today on Finance for Firefighters. Same as always, thumbs up if you like it. Comments below for anything else you have feedback on. Appreciate the time. Take care.